This is the Empowering Healthy Business Podcast, and I'm your host, Cal Wilder. Each episode, we'll dive into topics important to folks who want to run businesses that are both nicely profitable, sustainable, and scalable, and who want to achieve balance in their lives and realize their potential inside and outside of work. This show is sponsored by SmartBooks, provider of bookkeeping and accounting for businesses. Let's get started. Today I am rejoined by Greg Reid, who's the head of tax at SmartBooks Tax and Advisory. Welcome back to the podcast, Greg.
Thanks for having me back.
So last time you were on, you presented some tactics that small business owners can use to pay lower taxes. And that was exciting as it was helping people put more money or keep more money in their pockets. Today, the topic might be less exciting as it's more compliance-based about staying out of trouble, but I think we'll see that especially today versus a decade ago, it's just as important to address. This whole podcast is around empowering healthy business, and part of being a healthy business is managing risks in compliance to stay out of trouble and be sustainable. So before we dig in, I'll just share one more observation over the years with helping hundreds of businesses navigate conducting business in the U.S., which has a reputation as a very easy country to conduct business in. But when it comes to state and local taxes, it's very challenging. It can be. We're operating in more than one jurisdiction. We've got 50 different states with 50 different sets of tax rules. And within those states, we've got, sometimes city and town level tax issues to deal with as well. And so I work with some international clients based in Europe that really struggle to understand why it is so complicated to operate in the United States. So I'm excited today you're going to help us navigate the challenges of state and local taxes.
Yes. State and local taxes are very, very tough to navigate. Every state, every county, city, municipality has generally their own set of laws. So trying to make sure that you stay in compliance across the board can be very tricky.
So there are a number of different tax-related topics we could cover. Why is this one so timely to discuss now?
So the states are really starting to get smarter. They are sharing information with other states. They are sharing information within different departments within the states, and they are sharing states information with the IRS. With all that information sharing, they're figuring out how to correlate that, and I don't want to say catch people because a lot of people aren't doing this maliciously, but they're figuring out who is in compliance and who is not in compliance with various state filings.
Yeah, I can see, I can see how just the number of different jurisdictions that businesses are operating in has probably increased over the past several years with the rise of remote work, especially accelerated after COVID lockdowns had most people working from home for a year or two. And so I think businesses are probably finding themselves with employees who are living and thus also working, from home in more different states than ever. And I can tell you from my own experience trying to hire good people in this tight labor market, sometimes we just need to hire an employee in a new state when you find that great candidate. And I'd rather not, employ somebody in another state and have to deal with compliance for another state. But if I need to make a key hire and I found the great candidate who happens to live in a new state, I'd certainly be tempted to bite the bullet and make the hire and figure out how to comply with that new state.
Absolutely. As with most other things, COVID-19 definitely flipped the script on a lot of things. Remote work obviously being a big one. A lot of states gave business owners a little bit of a break, thinking, okay, maybe eventually that person who worked in New York but now lives in New Jersey and works is going to eventually be back in the city working, and that necessarily isn't the case. I think a lot of businesses have found that they can be just as productive having remote employees and not having to have that overhead. So now we're starting to see businesses who are employing, like you said, employing people remotely, but they're not necessarily thinking of the repercussions of that from a tax standpoint.
Right. So we've been referencing all these state and local taxes, but really, what are the different kinds of taxes that we're talking about now?
So there's a whole list. The common taxes that you'll often run into are sales taxes, franchise, excise, and income taxes. Those are three forms of a tax on income that various states will charge in one form or another. Property taxes, real estate taxes. You have payroll taxes and withholding. Withholding is not necessarily a tax, but you have withholding requirements, and then you have taxes on pass-through income potentially if you're an S corp or a partnership.
Okay, well, I'm sure we'll talk about each of these in a little more detail as we go to understand them. But how do we go about understanding whether we have liability for these taxes in a particular state or city?
So I always talk to my clients and say it's kind of a two-step process. Generally, you're going to you have to develop what they call nexus in a state to have a tax requirement. So the first question I get is, well, what is nexus? Nexus is your business's connection with a state or local taxing authority. It's created really one of three ways. It's created it's based on where your customers are. So like where you're selling to. It's based on where you own or lease property. So if you hold inventory, that's a good example of people who sometimes get caught. They might say, "Oh, I don't have any. I don't have any connection to Connecticut," but then you find out that they have inventory sitting in that state, waiting to be delivered to the New England area, and unfortunately, that does bring them into that does create nexus.
Right,
And
'cause
then
we could be talking about, a third-party fulfillment operation that runs a warehouse or something
yeah,
like that, right?
yes, and it does get a little tricky with Amazon because Amazon does handle some of that, and because you don't actually know where your goods might be. But keeping it simple, if you have a third party operator who is holding your inventory that isn't, Amazon, and you know where that inventory is, then that could certainly create nexus for you. But that's just one example. And then the third one is, like we already discussed, where your people actually work. And some states actually will try to grab you if you just have contractors in that state. So it's not just your W-2 employees either.
Okay. So, let's say you've analyzed all those factors and realized you do have some nexus in states. How do you go about, registering to comply with those state requirements? What's involved there?
So once Nexus is developed, okay, we're in this state, we have a filing requirement, one or several. You got to register to do business in that state. So step one is to file with the Secretary of State. That just, again, sets you up legally in the state to transact business. The second registration is with the state taxing authority. For example, you have the Massachusetts Department of Revenue, the California Franchise Tax Board. Those are just kind of the two big ones that I deal with mostly.
Yeah, I would add also, when it comes to payroll tax, there usually are multiple state tax agencies to deal with. There's usually one called, Department of Revenue or something like that deals with income tax, withholding tax. And then there's a Department of Labor or like employee services division or something that deals with unemployment.
Yep.
Unemployment websites are notoriously difficult. They're like the worst websites to ever try to navigate and register and work with. But,
they certainly don't make it easy.
No, definitely, usually there's at least two, if not, often three state tax agencies you have to register with and manage.
Yeah, and then I mean, I've never dealt with this, but there may actually be some local authorities that, New York City, I would imagine, has something that perhaps you need to register for. These are just things that if you're not thinking about them, then you need to find someone who at least knows enough to look into this. So once you're registered with these jurisdictions, then comes the fun task of maintaining these registrations. And I can't tell you how many times I will look up a client on the Secretary of State website and see that their business has either been involuntarily dissolved because they haven't maintained their registrations, or they're out of compliance because they just haven't filed. Now, like a Secretary of State annual report filing is typically an annual filing. That's why they call it an annual report. And unfortunately, some CPAs won't do those filings. It's not like a true tax filing. Some people have attorneys do it. A lot of times what happens, unfortunately, is, one person thinks that the other party's handling it, and that party thinks that the other party's handling it, and it falls through the cracks.
Right. It's one of those things that, they're legal filings, so it'd be nice if you had an attorney do it to make sure it got done right. But people just kind of want the CPA to do it as part of the annual tax return sometimes, right? Or they want a CFO advisor to do it. But, it's like nobody's full-time job to manage state registration. So you're right, they can fall through the cracks.
It can fall through the cracks, and unless you're a big company that has someone more or less dedicated to this process, then it can be something that you just don't think about. So it's something that we do here at SmartBooks. We also use or recommend, third parties to manage these filing requirements. I use it personally for my own business to manage these filing requirements. I get an email once a year. Mine's actually this month in August. They've emailed me several times now, basically saying, hey, we need to make this filing. Here's the amount due. They make it very easy, and you just don't forget about it. But again, it is a task that we created within our organization at SmartBooks to help clients manage.
Yeah, and part of managing is deregistering if and when you no longer have nexus in a jurisdiction too, and that's equally important because once these states get in the habit of receiving tax returns and tax payments from you, and then they stop receiving those tax returns and tax payments, they assume you just have neglected to file, and they're happy to mail you a tax assessment for however much money they would estimate you owe them.
Yeah,
it can be very frustrating to deal with that.
Yeah. So all those things that we talked about on, getting set up, you also have to deregister, and oftentimes telling them that you no longer want to pay them can be more difficult than actually signing up. What I found is as these states develop more technology and get a little bit more tech savvy, they make the registration process a little bit easier to navigate, but the deregistration process can be somewhat of a nightmare.
Right. So one of the first tax types you mentioned that impacts, aside from annual income or excise or franchise taxes that impacts businesses very frequently, is probably sales tax, right? Sales tax, payroll tax, franchise excise tax, pretty universal, unless you're in a pure niche industry that does not have any sales tax requirements in any of its jurisdictions. But what's involved with sales tax these days?
Yeah, sales tax. So a few years ago, when the Wayfair decision passed, basically to give you a quick recap on that, um, your grandfather's company in 1985 that would ship, or maybe that's a little early, but whatever. The companies before the Wayfair decision that would potentially just ship goods to another state, customer in another state. Once it touched the UPS truck, it was no longer their issue. The states had no idea, how to manage this process, and the Wayfair decision changed that and basically said that if you have sales to a specific state, then you are potentially subject to sales tax, and uh, that created a massive filing requirement for businesses across the board, and to the point where a lot of businesses didn't realize that they had this filing requirement. For the longest time, if you were a Massachusetts-based business, you had no other connection outside of that other than maybe the occasional mail order that you delivered or that you had a third party deliver. Then you would just file your Massachusetts sales tax in Massachusetts because that's where you had Nexus. But then all of a sudden, Wayfair passes. You might have uh, a sales tax nexus in multiple states. We actually had a client a few years ago who we did a sales tax nexus study for, and we found out that they were doing just that. They were filing in just Massachusetts. All those sales that were going to other states, they were in essence just ignoring. We figured out that they were in 21 other, they had Nexus in 21 other states. They hadn't filed for 3 to 4 years. And because they haven't filed, the statute of limitations never started. And they essentially had to go back and pay all those back taxes. We were talking upwards to around $100,000 in back taxes. That does not include the penalties and interest that the states are legally allowed to charge you for.
Hmm.
So I guess now that I've sufficiently scared everyone, we should talk about, how can we make sure that these issues, okay, maybe they have arisen. How do we mitigate them? What do we do to get back into compliance? And how do you move forward from this? Because eventually the states will catch up to you. Like I said earlier, the states are starting to get smarter. They are they are sharing information with other departments within their states, other states, and eventually they will find you because all the states are hurting for money right now, and they know where to get it. They just have to figure out how to make that happen, and then the floodgates will open.
And
So
this could ensnare businesses that might not really think they have sales tax requirements, right? Traditionally, if you sold a physical product and you sold a decent volume of it into a state, you kind of knew you probably had some sales tax liability because if you're selling widgets, they're products and just about everybody taxes products. But right, there's services that are subject to tax. There's products that get sold like a service that are
yep.
taxed. So how do you go about figuring out what is really taxable where you're operating?
Absolutely. So, like you said, physical goods are typically subject to some form of sales tax. That's pretty easy. Some industries have different tax rates than other industries, depending on the state that you're in. Um, some some states will provide either sales tax credits or reduced rates based on the industry you're in. But the big thing that I find with clients is if they sell a you sell a physical product, but there is also a service component with that. So say an install, you uh, let's just take a plumber. Um, they uh, will sell you a pipe, but then they also install it. You would say, okay, well, the pipe is subject to sales tax, but the installation is not. Depending how that plumber puts that on his or her invoice, uh, the service component of that could be subject to sales tax. So if you want to be safe, then you would have to break out the service piece and the materials piece on your invoice.
Hmm.
And again, that's an example. None of this is like all inclusive. This is why, again, I think it's sales tax is just one of those things where you really need to have someone in your corner who understands these laws.
Right. You could go to your tax CPA, your generalist CPA, but these are really very specialized questions if we're operating outside of the home state that the CPA typically practices in. I know we've had clients that we've, referred specialist firms whose primary practice area is sales and use tax
Yep.
to do a large study to figure out what the actual compliance requirements are. So first step is probably your regular tax preparer, but the second step might be finding a specialist.
Yeah, and again, it depends on the size of your business. Um, yeah, you could go find a specialist if you engaged with a larger firm. A lot of big firms, national firms have SALT tax divisions. Um, you're also going to pay for that service. So if you're a small business owner and you think that you might have some sales tax filing requirements, then your CPA is a great place to start because that person should have a general knowledge of sales tax and they can do the research and know how to do the research. There's 12,000 U.S. sales tax jurisdictions in the United States. It's not just the 50 states. There's counties, cities, towns, and so you need to. No one's going to know all the rules, and we can't expect CPAs to know all the rules, but we do uh, need to know how to find the answers um, and what to look for.
We could probably talk about sales tax all day, but in the interest of moving on, just one more related topic, which is use tax, right? Where states and jurisdictions expect you to effectively self-assess the sales tax that you would have paid if the vendor charged you for sales tax on their invoice. So we're in Massachusetts, who has a sales tax, and our northern neighbors in New Hampshire do not have a sales tax. So we go buy a TV or a computer or a desk in New Hampshire and drive it back to Massachusetts. We didn't pay any sales tax when we bought that in New Hampshire. So we're supposed to self-report use tax on that purchase to the state of Massachusetts, right?
Technically, yes. And that can just, again, be a tricky thing to track. But
And so one-off purchases are probably pretty low risk, but where I've really seen problems happen is more on the internal use product purchases. For example, I was in the IT services industry prior to SmartBooks, and we resold, part of our business was reselling hardware, computer hardware and software. So we buy a lot of computers, and this was, before everybody did everything in the cloud. So we resold a lot of computers and servers and software licensing. And of course, we had to buy computers and software to run our business internally. And we were set up as a tax exempt reseller with the distributors, so we could order computers for internal use. Ingram Micro or Dell or whoever the distributor was not going to charge us sales tax because we had a blanket reseller account with them. And we had to self-assess use tax. Now, some people in our industry chose to try to save the 5 or 6 or 7% tax on internal purchases. And if you do that for a number of years, and then you're audited, you're gonna have to pay that tax plus penalties and interest, right? It's just no way around it. If you're in certain industries where the tax agencies know that you have the opportunity to buy internal use products without paying sales tax, they're naturally going to want to target those industries, right?
Yep, absolutely. And you might be saying to yourself, well, how would they ever find me? Again, I go back to these states are getting smarter and they're hungry for money. And, some states have what they call business personal property taxes, where they will assess tax on the fixed assets that you own. And if they start looking at those fixed assets and they start asking for invoices maybe or receipts, this all goes into a database where there's information sharing, and that that's a local tax, but they could potentially share that with the Department of Revenue, who will send you a bill for, hey, you didn't pay your use tax on that, or they will put the ball in your court and say, please prove that you paid use tax on that.
Yes. All right, so moving on, let's talk about more the annual corporate level taxes. There are a number of different names I've seen around for. So what are we looking at for kind of annual corporate taxes?
Yeah, so you have a franchise tax, excise tax, income tax. These terms are often used interchangeably. They're typically based on either like a sales revenue or a net worth. Sometimes they're called, in Massachusetts, we call it a sting tax for pass-through entities, because you would say that a pass-through entity shouldn't be subject to additional taxes. But if your net worth is high enough and surpasses a certain threshold, then Massachusetts will assess you a tax, and they call it a sting tax because when they do assess that tax, it stings. Massachusetts also has a minimum tax of $456. Don't ask me where they came up with 456. I have no clue. But that is just a cost of doing business in Massachusetts. A lot of states have these minimum taxes as well. Some of them are based on revenue. So for New York, for example, they have a kind of a tiered approach based on your total revenue. It starts at $50 and goes up from there. Like I said, some states just have the minimum tax, like Massachusetts. This applies generally across the board. So S corps, partnerships don't have a minimum tax in Massachusetts, so they don't have to pay anything. But S corps and corps do.
Usually it's pretty de minimis. It might be a pain to deal with, but right, we're usually not talking about many thousands of dollars for a pass-through entity unless it's a really large entity that has to deal with a stinger type tax, right? It's C corps that tend to have the larger bills, or?
But they are de minimis, but I keep using Massachusetts, for example, because that's where we're located. But if you go to extend your tax return and federal offers, you do your federal extension, and then your Massachusetts extension, you don't pay that 456, that extension is void, and now you're a late filer. So it's de minimis, but it's very important that it's paid on a timely basis.
Right, right. You gotta stay out of trouble unless you're in one of those few states that don't have business income tax, right?
Yeah, and so there are some states that are a little bit more favorable to do business in than others. Wyoming is one of them. Nevada has what they call a gross receipts tax, but they don't have necessarily like an income tax. So if you maybe have nexus there, but no income, then you're exempt from any taxes there. Um, South Dakota, Alaska, and then Florida obviously is a popular one.
But just to be clear, even if you were to incorporate a business in those states, if you're actually operating in another state, you get no benefit from being incorporated in one of those states, right?
Correct. Yep. As long as if you incorporate in these states and that's your only presence, that's great. But whichever state you're actually operating in, then you have nexus there because you are there. Um, if you're the sole employee.
That comes back to the whole nexus discussion you had earlier, right? All
Yep.
right. So moving on, what's the next type of tax we need to worry about?
So I alluded to this earlier when you were talking about use taxes, but property taxes and real estate taxes, and I think um, these are common, and I think we all uh, understand them. But again, it's just another form of tax that we have to think about. So these are typically assessed by the counties, cities, or towns. Um, It's the real estate tax is no different than what you would pay on your personal residence. It's just a tax based on commercial real estate that you may own. Obviously, if you lease, this is not an issue. Um, some states do, like I alluded to earlier, do tax business personal property. This can be a little bit of a surprise to business owners,
It was a
where
surprise to me, I'll tell you. My first business, I was like 26, 27 years old. We're a couple of years into the business, and we hired a seasoned controller. I'd never heard of personal property tax. And one day, Hayden asks me if we're filing personal property tax returns. I must have given him a blank look. I figured, yeah, we paid sales tax when we bought the equipment. I had no idea you had to pay ongoing property taxes on desks and filing cabinets and computers.
oh yeah. Um, yep, and the best part is the states will or the counties or local jurisdictions will send you a bill and just expect you to pay it based on what their records say. Now, that could work in your favor or it could not work in your favor. So, I mean, you do have the ability um, to appeal that and provide the documentation for the assets that you do have in that state, but it's a very tedious process, and typically it's at the end of the day it's probably not worth it. So unlike other taxes here in the U.S., where you basically tell them what you think you owe. They tell you in this case what you owe, and it's your job to make sure whether that's accurate or not.
Okay. All right, moving on. One of the taxes that I find most aggravating to deal with is payroll related taxes. So, what are we looking at there, Greg?
Oh, me and you both. Yeah, payroll taxes are just something that can be they can get you in trouble real fast. You know, as we alluded to earlier, you have unemployment taxes, you have withholding taxes, some states have a disability tax, that all these taxes have to be calculated based on your industry. There may be other factors there based on the number of full-time employees. There may be some factors there. There may be some local taxes that you need to think about as well. It is the business's responsibility to collect and remit a lot or all of these taxes, right? Even if it's on behalf of the employees. And there's no way to make employees angry, no faster way to make employees angry if you mess up their withholdings and W-2s and all that jazz. Because, unfortunately, they're expecting that you get this right.
And this is the taxes they consider, correct me if I'm wrong, but trustee type taxes where they hold the business owners and executives personally liable for any unpaid payroll taxes, right?
Yeah,
If the business
exactly.
files bankruptcy, they can still come after the owners and executives if there are unpaid payroll taxes.
Yeah, exactly. And it's a headache for the employees, it's a headache for the businesses. In general, my first or one of my first pieces of advice to growing businesses who are hiring people, especially people in other states, is to find an advisor or a payroll company that is has a good reputation and is well versed um, in multiple states, because payroll is just one of those things, kind of like sales tax. You can get into a lot of trouble very quickly.
And often we've seen when it comes to payroll tax, unlike somebody, over deducting personal expenses and getting in trouble by trying to save money on income tax, payroll tax, when people get in trouble, businesses get in trouble, often it's not intentional as much as it is a question of just not knowing what to do and it being very complicated because we've got multiple jurisdictions. You've got at least two tax agencies typically to file and pay in for unemployment related type insurance and for withholding and income tax type taxes. And
Yep.
you've got to register. You have different registration numbers. You've got to set all this up within the payroll software. You're not an expert on this. The payroll service, unless you get one that's very diligent and it's really helpful in this area, they just think, well, you're the customer, you're the administrator of the system, you're responsible for setting up your own employees and doing adds, changes, removes, and configuring taxes. And if you ask us a question, we might be able to help you, but we're just going to assume you're on top of it. And so if you don't plug in the unemployment tax number for a state or the withholding tax number for the state, the payroll service is just going to run payroll based on how it's set up. And if no withholding tax is paid to that state, you might find out about it 6 months later when that state sends you a big tax assessment bill in the mail. And so,
And now you're 6 months behind.
yeah, so that is the key is managing all these different registrations with the payroll service to make sure that A, the taxes are being assessed at payroll time, and B, those tax returns are being filed and successfully received by the state, and the money associated tax is getting paid and applied by the states. So it's kind of a multi-step process to try to audit every now and then to make sure it's working right.
Exactly. Yeah, it's a very tricky situation. And like I said, you can get into trouble really quickly. Um,
So in terms of kind of mitigating the risks there, what we've seen is, some payroll services make it pretty easy to see copies of the state tax returns and confirmation that they were accepted, and they'll give you a list of payments that were remitted to different tax agencies. So I think of Gusto as being one that makes it relatively easy to see copies of these returns and the payment history. And then you can go to the state and request a certificate of good standing from the tax agencies and generally make sure that you're staying current. But not all payroll services are as easy to navigate with this.
No. And as I said earlier, the states are getting better at technology and putting some of this information up on portals and keeping it up to date. And so, it's always a good idea to, once you're registered with these state taxing authorities, to log in and, maybe once a month and just, check, is everything look good? Do I have any open balances? It's a little bit of a pain, but it could be 5 minutes of, your day that saves you a lot of headaches in the future.
Yeah, this is something else that, like the annual reports, can tend to fall through the cracks if nobody's got it as their primary job responsibility, because the tax CPAs aren't going to think to do this, or they're not contracted to do this. The business owner is too busy running the business to want to deal with this. The bookkeeper or the accountant doesn't really know much about payroll because it's so different than accounting and bookkeeping and financial reporting. And the small businesses don't have a separate payroll manager who should understand more about this. So it can be challenging to make sure this doesn't fall through the cracks, and just make sure somebody has this on their list of responsibilities.
Yeah, and if you're only talking to your CPA once a year, um, when they file your taxes and they start looking at things and maybe asking questions, um, then at that point it might be too late. Um, so I mean, it's something that I do, as I'll do kind of a sanity check on what I based on the wage number and what I know that the withholding rates generally are. Um, just to make sure, okay, are we in the ballpark, and does this make sense?
Right.
Um, but like I said, at that point, it might be too late. Now, I will say, along with sales tax and some of these payroll taxes, states aren't trying to, they understand that business owners aren't necessarily um, trying to evade taxes intentionally. So they do offer voluntary disclosure programs where basically if you go to the state and say, I messed up, this is, how much tax I owe you, they are a little bit easier on you when it comes to penalties and interest.
Okay. I'm getting kind of tired of talking about different tax types, but I know we've got at least a couple more. What's next on the list, Greg?
So this last one is one that I think, I mentioned it in our last podcast, and I'll mention it again. It is a great way to save money on taxes. So, in response to the state and local tax cap on itemized deductions for individuals, um, basically capping your income and your income tax and other local taxes on your itemized deductions at $10,000, which in a high tax state is could could have lost you, $20,000-$30,000 out of a deduction. The states have enacted what they call a pass-through entity tax election. So this is, again, every state does it a little differently, but it's typically an election that you have to go in and make at the state level, and you are essentially paying your individual income tax at the entity level. You pay it throughout the year as if you would um, any other um, estimated tax payment. And what it does is it puts the tax on the federal income tax return as a deduction, which gives you a deduction on your personal taxes if you're passing that income through.
And if I
So,
remember right, one of the big issues with this one that gave rise to the pass-through entity tax is the $10,000 annual limit on federal deductibility of local homeowner property taxes.
yeah. Yep. So your it's your property taxes and your excise taxes on your car, or personal property taxes, and your income tax, your state income taxes, all those get added up and then capped at $10,000. Most, depending on where you live, you might hit that cap easily with just your income tax. Never mind real estate taxes or anything.
This strikes me as a classic example of uh, complicating the tax code for arguably for no good reason, to put it in.
It is I'll tell you what it is. It's a negotiating tactic, and it's been on the chopping block now to be repealed several times, and every time it gets it again. It's a negotiating tactic. It gets pulled off. Um, a lot of politicians do not like this.
I think the challenge, I find it a little bit curious. I think it's just an ultimate commentary that no matter how people like to vote, who they like to vote for, Republican, Democrat, nobody wants to pay any higher taxes personally than they have to. I mean, these taxes impact people who live in expensive homes, who drive expensive cars, who live in expensive cities. And those places tend to vote for policies that increase government spending programs, and you need higher taxes to pay for those programs. But when it comes time for them to actually have to pay those taxes that they support, they lobby hard, and we get this new complicated tax apparatus in place to try to avoid paying those taxes. And now everybody has to deal with this complicated tax, pass-through entity tax. Instead of simply making a policy decision, do we believe in taxing people who have high home values and expensive cars more than others? Yes or no? And so we just complicate the tax code. But the good news is for you and for CPAs like you who take a very consultative approach, you've got a lot of job security helping people plan and manage these taxes.
Yeah, Massachusetts just enacted the millionaire's tax, which is an additional 4% on top of the 5% that we already pay for people who make over $1 million. Again, just another level of tax that we have to think about at the state and local level.
Right.
So in addition to the pass-through entity tax, some states actually require businesses to withhold for pass-through income from non-resident shareholders. They also might require that you withhold for payments to vendors. So for out-of-state vendors, and they do this just to make sure that they're able to catch that tax dollar. Otherwise, it's a lot harder to recoup that tax once the money has essentially left the state. They know where you are. They don't necessarily know where your vendors or where your owners are. So they do. That's I wouldn't say new, but the states are starting to really like that tax or that withholding amount. And that's another one that could potentially sneak up on you, because without paying that, the business itself could be subject to penalties and interest.
Okay, are we done? Do we have any more taxes we need to talk about?
Those are the big ones.
Okay, so if I'm a small business owner and I operate in one state, I don't have to worry about too much. I just have to make sure I'm understanding and compliant with the rules of the one state that I operate in and probably live in, which isn't too daunting. But for business owners that operate in multiple states, they get a sense for they probably do have some nexus liabilities that are unaddressed. Like, where should they start?
So again, you might think, okay, I don't have any nexus in another state, but you just hired an employee in another state, and now you have nexus. So a few things to say about all that. Where do you start? You got to find someone who, again, knows how to find the answer and isn't just looking at you as just another tax return. You have to work with your CPA to make sure that they're keeping you in compliance throughout the year. As I alluded to earlier, if you're just talking to your CPA once a year to get the taxes filed, that's probably not your best bet. You really need to have that open communication. If you hire someone, hey, what are the tax implications? This is exactly why I don't charge people per phone call. I really want to have open communication with my clients, and I don't want them to feel like they're getting charged every time I pick up the phone. I'd rather deal with these issues throughout the year rather than, oh, by the way, I hired 7 people in several different states this year, this past year. So keep your CPA involved, and have those conversations. Quick email. Hey, are there any tax implications here that I need to think about?
Makes sense. Before we wrap up here, Greg, is there anything else you want to make sure to mention?
So I know we're talking about all these different taxes, and you're probably thinking that you're ready to leave the country. It's not all bad. You do get a credit for a lot of the taxes, a lot of these local taxes that you pay, either at the federal level or at the state level. So you're not paying multiple taxes on the same income generally. We didn't even talk about apportionment today because that is something that, in my opinion, business owners shouldn't have to worry too much about if they have a good CPA. But apportionment is basically, how do you slice up that income between the states, and depending on what state you're in and what state you're doing business in, if you know the rules, then you can actually, use that to your benefit as a tax saving strategy. So that's just another thing to think about. Maybe bring up to your CPA is, hey, how are we handling the apportionment? But otherwise, final piece of advice is, again, just find someone who you trust that is well versed in these issues to keep you out of trouble.
Well, thank you, Greg. I know this isn't the most exciting topic, but I really believe if we can help audience members stay out of trouble and avoid having to spend all the time and stress and cost associated with resolving compliance problems, then that's a big win. I mean, that's part of running healthy businesses. So I really appreciate your time, Greg. If anybody wants to follow up with you, where can they reach you?
So the best place to reach me, go to our website, smartbookstax.com. You can make an appointment with me right there, direct access to my calendar, and we can at least chat through some of these questions and maybe see if there's anything that we can do to help you or save you some more money on taxes.
Great. Thanks, Greg. We'll talk soon.
All right. Thanks for having me.
Another episode in the books. Thank you so much for tuning in. For show notes and more, visit empoweringhealthybusiness.com. If you would like to have a one-on-one discussion with me or possibly engage SmartBooks to help with your business, you can reach me at C-A-L, at empoweringhealthybusiness.com or message me on LinkedIn where I am easy to find. Until next time, this is Empowering Healthy Business, the podcast for business owners, signing off.